Hello everyone, my report is all about international portfolio investment. First, risk-return characteristics of capital markets. Investors simultaneously considered both risk and return in making investment decisions. In other words, they want to maximize expected return for a given amount of risk and minimize the amount of risk for a given level of return. Consequently, we also examine the risk-return characteristics of stock markets. In this figure shows the performance of these portfolios in terms of risk-return trade-offs. As the proportion of the portfolio invested abroad increased, the return increased. In addition, the risk decreased until the proportion of foreign equities reached 50% of the portfolio. In other words, American investors could have enjoyed higher return and less risk if they had held a portfolio that contained up to 50% invested in foreign stocks. To ascertain the gains from international diversification, Morgan Stanley constructed portfolios that began with a 100% US portfolio and then they made it increasingly more international in increments of 10%. Switching from domestic to foreign investments was implemented by acquiring equally weighted portfolios of the 20 foreign indexes in Europe, Australia, and the Far East using quarterly data for 71 years from 1926 to 1997. Now let's move on to the selection of an optimal portfolio. Before we discuss the selection of an optimal international portfolio, let us review the basic concept of bonds and stocks. Bonds are less risky than stocks. The standard deviation of bond returns in any particular market is typically lower than the standard deviation of stock returns in the market. Certainly, lower risk implies lower mean rates of return for bonds compared with stocks. In this table shows risk-return statistics for bonds and stocks in various markets from the viewpoint of a U.S. investor. In terms of the mean variance decision rule, both bonds and stocks were efficient investments in each market. With the exception of Germany, all the bond means and standard deviations were lower than the corresponding stock statistics in each market. Figure bond portfolios definitely outperform the stock portfolios. At every level of mean return up to 11%, the bond portfolios had a lower risk level than corresponding stock portfolios. However, the efficient bond frontier stops at a mean return level of about 11%, while the efficient stock frontier extends up to a mean return level of about 19%. The upper bound represents investment in Japanese stocks, which had the highest risk and return among all stocks. The higher range of risk-return combinations was not attainable with bond portfolios. Still, the stock portfolios played an efficient role on their own because of their upper bound. Now let's move to methods of international diversification. U.S. investors try to obtain international diversification through one of the following methods. First, international mutual funds. Second, purchases of American depository receipts. Third, direct purchases of foreign securities. Fourth, hedge funds. Fifth, investment in U.S. multinational companies. International mutual funds. International mutual funds are portfolios of securities from various countries. Investors may purchase shares of an international mutual funds with a small minimum investment, such as $1,000. Mutual funds are perhaps the most important byproduct of the portfolio theory developed by Markowitz and Sharpe. Mutual funds are financial institutions that accept money from savers and then use these funds to buy a variety of securities. International mutual funds have several advantages over individual foreign securities. First, international mutual funds pool funds and thus reduce risk by their diversification. Second, investors would have to pay extra transaction and information costs if they attempted to buy foreign securities directly in foreign markets. Third, international mutual fund investors circumvent many legal and institutional barriers associated with direct portfolio investments in foreign markets. There are two classes of international mutual funds. First, the open-end Mutual funds are funds whose total number of shares under management grows and shrinks as investors buy and sell the funds. They stand ready to issue and redeem shares at prices that reflect the net asset value of underlying foreign shares. The second one is closed-end funds, are funds where the amount of money under management is fixed. They issue a fixed number of shares against an initial capital offering, and these shares then trade in secondary markets at prevailing market prices. These shares are not redeemable at the underlying net asset value of the underlying foreign shares. There are approximately 300 US-based international mutual funds, which can be grouped into several families of mutual funds from a US perspective. First, global funds invested in US and non-US securities. Second, international funds invested in only non-US securities. Third, regional mutual funds invested in particular geographical areas. Fourth, country funds invested in single countries. Next is the American Depository Receipt. The American Depository Receipt are securities distributed in the USA backed by foreign stocks. Investors may purchase American Depository Receipt, which are traded on organized exchanges and in the over-the-counter markets. Exchanges around the world have listing requirements before they accept a firm's shares for trading. Rules for listing vary markedly from country to country, with US requirements being among the most restrictive. American Depository Receipt represents the ownership of underlying foreign stocks that are held in custody by the bank that issues them. In other words, the bank holds the foreign shares and trades American Depository Receipt that represent title to those shares held on deposit. In effect, the bank owns the shares and trades claims against those shares. American Depository Receipt have become so popular that companies have begun to issue global depository receipts. Global depository receipts are similar to American Depository Receipt, but can be simultaneously issued on stock exchanges all over the world. Let's move to direct purchases of foreign securities. Investors may buy foreign securities listed on foreign exchanges through stockbrokers for inclusion in their portfolios. This method of international diversification, however, is not recommended for small investors because of market imperfections such as insufficient information, transaction costs, tax differentials among countries, and different exchange rate risks. Alternatively, investors may invest in foreign securities listed on US exchanges in the same way as they can buy any US stock listed on a US exchange, because the number of foreign securities listed on US exchanges is limited. This route by itself may be inadequate to obtain full international diversification benefits. Next one is the hedge funds. Hedge funds are private partnerships with a general manager and a number of limited partners. Unlike other investment tools such as stocks and mutual funds, these hedge funds are largely unregulated investment pools open to only wealthy investors. Many hedge funds use short positions or debt that prices will fall. To offset their securities holdings, some bet on cross-border mergers and acquisitions, convertible securities, or foreign currencies. They frequently use borrowed money in an effort to boost returns. Hedge funds have grown in popularity in recent years, both because of their oversized returns and their aura of exclusivity. Hedge funds have recently become the target of frequent criticism in the financial press because of the lucrative compensation packages paid to management, the fact that they are unregulated, and the huge speculative positions taken by some hedge funds. For these reasons, experts suggest that an investor should ask the following questions before putting money into a hedge funds. First, how does the investment strategy work? Second, what are the risks? Third, what market conditions favor the manager's strategy and which ones work against it? Fourth, what is the manager's experience and track record? Fifth, how long do I have to wait before I can withdraw my money? Sixth, how are the manager and the consultant helping select the hedge fund compensated? Now let's move on to investment in US multinational companies. An MNC represents a portfolio of international operations. Its performance is somewhat insulated from US market downturns. An MNC can reduce risk by diversifying sales not only among industries but also among countries. This means that the multinational companies as a single firm can achieve stability similar to that of an internationally diversified portfolio. And last, the global investing. Empirical studies conclude that international diversification pushes out the efficient frontier, thus allowing investors simultaneously to reduce risk and increase return. This benefit exists for a number of reasons. First, more profitable investments are possible in an enlarged universe because faster growing economies create higher returns or investors may see another advantage from currency gains. Second, the advantages of international diversification may occur because companies in different countries are subject to divergent cyclical economic fluctuations. The manager of a US stock fund has just one way to beat the competition by making better stock picks. But an international stock fund manager has three different ways to add value by picking countries, by picking currencies, and by picking stocks. How can US investors best select a global fund? Some helpful hints may cut down on the potential for loss. Clements 1992. They are: first, stick with large players in the global market. Second, combine funds to minimize the effect of the failure of one fund on the total portfolio. Third, select regional rather than totally global funds. Fourth, consider combining regional funds with stock or bond index funds. Fifth, try publicly traded funds. These suggestions will not assure a success, but can reduce the likelihood of failure. That's all, thank you.